Donald Trump has declared a breakthrough in the much-anticipated trade deal with China. But can investors, businesses, and consumers really expect normalcy? Well, for now, that still seems a distant promise. The U.S. president announced that both sides have reached a framework agreement after nearly 20 hours of high-stakes talks in London. The deal revives the long-stalled Geneva consensus and crucially brings China's rare earth exports back online. Materials vital for American cars, smartphones, and defense systems. Trump says the U.S. will keep a total tariff of 55% on Chinese goods. Now that includes a 30% base tariff and 25% levy on select products. Now, China, in return, applies a flat 10% tariff and will resume shipments of rare earths and full magnets to the U.S. The framework still needs a final nod from both Trump and President Xi Jinping. At the heart of the deal lies China's grip on rare earths used in everything from electric vehicles to medical devices. China controls more than 70% of global mining and nearly 90% of refining. This deal, if it holds promises upfront supply of key materials. The U.S. also agreed to allow Chinese students to return to the American universities, an issue Beijing had pushed for. But key sticking points remain unresolved. China wants Washington to ease restrictions on semiconductors, design software, and jet engine components. That demand is still on the table. Meanwhile, U.S. seeks more responsibility on the part of China to manage its export dependence. U.S. Treasury Secretary Scott Bessent flagged the trade imbalance in China's economy, calling for more checks on its domestic indicators and exports.
China currently has the most imbalanced economy in the history of the world. They now have an approximate 30% share of global manufacturing, and they continually grow their manufacturing base. They are in the midst of a real estate downturn, some may cause a crisis, and they are trying to export their way out of it rather than take domestic measures such as increasing consumption, dealing with banking problems, or dealing with the real estate crisis. They cannot be allowed to export their way back to prosperity, which would mean substantial decreases in the standards of living, not only for the United States working Americans, but for working citizens across the world.
The impact of this deal is fully implemented and could be significant. For businesses, it could mean fewer delays and lower input costs. Consumers, it may ease price pressures. But the road to recovery won't be smooth. Tech giants like Apple are already feeling the squeeze. The company estimates a $900 million hit per quarter from current tariffs. Meanwhile, Chinese e-commerce giants like Shein and Temu are reeling after the U.S. closed the $800 tariff-free import loophole. The broader context matters. Trump's earlier tariffs had reached a peak of 145%, effectively freezing bilateral trade. Economists had warned of recessionary risks. This agreement might offer a temporary thaw, but deep-rooted mistrust, structural trade barriers, and strategic rivalries will take much longer to resolve. Well, for now, Wall Street is watching. Investors want calm, but they also know that one handshake does not end a trade war.